Today I'm going to be looking into a long-term investment into the S&P 500. Before I start this video, please remember that I do these videos just for fun as a hobby and always speak to a qualified financial advisor before making any investment decision. The value of the S&P 500 has tended to go up across time, and that does make sense if you think of inflation, and also over time a lot more dollars are put into circulation, making their actual value go down. So the value of the stocks in the S&P 500 go up through that effect. Plus, of course, the US economy in terms of GDP also goes up generally by about 2% a year. And so this explains how the value of the S&P 500 has gone up over time. What's interesting when you look at the long-term view is that ever since 2009, when we started to see the new Keynesian economics policies of zero interest rates and lots of money printing, the gradient at which the S&P 500 increase seems to steepen. And here we see how after the 2008-2009 financial crisis, we had zero interest rates and the beginning of quantitative easing. According to the PhD geniuses over at the central bank, they can meet the government's objectives of 2% inflation, 2% GDP growth, and low unemployment, with secret secondary objectives of good stock markets and high house prices, by manipulating the interest rates and quantitative easing. And then also the government can help out too by large socialist government spending and lots of infrastructure projects and money handouts, such as the recent Inflation Reduction Act. Of course, this is only enabled in the US because it has the luxury of being the world reserve currency. Lots of other governments would rather own US dollars because even though it currently runs a government debt of 120% GDP and a fiscal deficit of 8% of GDP per year, even if that looks really bad, a lot of the other world's governments and economies are in a much worse situation. So that leaves the US dollar as the default currency of choice. And this enables this loose monetary policy and this new Keynesian economics phenomenon to actually be a thing. On top of that, it's also been enabled by lots of deflationary forces that have been inherent over the last few decades, particularly the growth of the internet and the progress of technology. And actually AI is emerging as potentially a huge deflationary force that could also further enable this behavior, and actually perhaps in the long run could lead to fully fledged to full blown modern monetary theory as well. Probably the biggest deflationary force though has been globalization, where we've been able to get really cheap commodities from Africa and really cheap manufactured goods from China and Asia. These were countered in recent years by the low interest rates and the energy crisis, plus the supply chain crisis. So there were a lot of rocket boosters blasting a few years ago. If you go back and look at some of my earlier quarterly macro updates that I do, I go into all that. But for now, those inflationary countermeasures seem to have abated. But it's important to remember that this new Keynesian economics, which the central banks and governments have been using, this has enabled this rather sporty looking gradient in how the S&P 500 has gone up. It's only happening because of these global economic factors that enable it. So 4 years ago, just before we had the Wuhan outbreak, the actual S&P 500 is actually up 42% since then. We had that crash because of the government's behavior following And then in response to that, we went back down to zero interest rates, and the Fed printed 4.5 trillion. And this was successful in stimulating the economy and led to this absolutely astounding increase in the S&P 500, where it effectively doubled in value. That then, however, caused lots of inflation, and we've got here the famous box plot where this is what the Fed said was going to happen, and then this red line here is then what actually did happen in terms of the incredible inflation we got. And so in response to that, the the central bank started increasing interest rates sharply, and this led to the bursting of the FANG bubble, and we had a bit of a bear market with the S&P 500 actually going down by about a quarter. However, in the last year or so, the central bank started to slow down their increases in interest rates. And when we look at this year, they've now stabilized at 5.5%. And it's now widely believed that they're going to stay there and maybe start going down next year. Now, I myself have been very defensive over the last 4 years, never actually more than about 30% stocks. And although I tend to actually invest mainly in UK stocks, but there's been a lot of sentiment widely that we perhaps could be going into a recession in the US. But as I've been tracking the macro, things never seem to get that bad this year. And actually, a couple of quarters ago, I started talking about this technical formation that I noticed. We have a classic, slightly asymmetric triangle, and I started postulating that we could have this all hail new Keynesian economics direction for the S&P 500. Well, last week we absolutely smashed through the upper barrier of this technical pattern here. And so now I'm in the belief, having gone over the macro as well, that this is the trend we're going to be following, which for me does line up with what we've seen in the past as the longer term trend, which I think is important, and also in consideration of the ugly world we live in. So just to cross check that, if we look at the macro here, we think that the interest rates have now topped out, and inflation would certainly back that up. Quantitative easing is actually still at 8 trillion to the nearest trillion. Although they're gently easing that, it's essentially all that cash that got pumped in. They're maintaining really with just a very gradual decline. Inflation has now dropped to 3%, but I don't really like using the year on year. I prefer to look at CPI month on month. And I plot that into quarterly bundles for better data. And here we see that we're actually now in a slight negative number. So it really does appear that the inflation issue has gone away. Now, I would hazard that if this trend was to continue, then if the direction of that was continue, we would then actually enter really nasty deflationary territory. However, overall, when I think about GDP growth as well, I'm kind of actually expecting it to bobble around here for a good year before then returning to normal, which is this kind of trend that you saw back in 2019. However, it's important to note the continuation of that trend as a risk. When we look at GDP growth, that's extremely strong. Here's the latest GDP Now data, which is at over 2% for Q4, and the blue chip consensus is around 1%. So we're looking at very good GDP growth because the traditional yearly number would be 2% you'd be gunning for. So we're actually, to have that number actually just within a quarter means we are on a very good fourth quarter. Also, house prices are doing great and unemployment is doing great. So on my dashboard here, the current situation is looking really good in the US in terms of the macro. Something I should say is that if you look at the FTSE 250, we see that we've just finished off a 2-year bear market, in contrast where it dropped 30%, in total contrast to how the S&P 500 has performed. And the and the UK and also rest of Europe and a lot of the rest of the world has worse macro than the US. So how I explain how the S&P 500 has done so well compared with them and is now kind of powering ahead, potentially I think ahead of stocks starting to recover in with perhaps a bit of a lag around the rest of the world, is that the US is a hydrocarbon rich country. It has excellent hydrocarbon resources and it's a hydrocarbon exporter, whereas in the UK, for example, we've actually undeveloped our own hydrocarbons and instead we're actually importing gas and oil from the US. So that puts us at a disadvantage. And also, if you look at the stocks that are in the S&P 500, it's all IT stocks. There's lots of AI stocks, and the US, the stocks you find in the S&P 500, that represents those of a first world country. And the truth is that the US is a first world economy, whereas if you look at the stocks in the UK, we have a second rate economy. Our main stocks are things like oil companies, pharmaceutical companies, banks, consumer staples. So although, we are second world and, these aren't like third, we don't have a third world stock market, still we're well behind the US when it comes to the technology and the kind of cutting edge nature of our companies. And the US, the companies that inhabit the US, these are the global leaders that really do have a total grip over the entire planet, really, in terms of extracting money from consumers and businesses. So that's how I explain this performance of the S&P 500 and also the better performance of the US macro when you compare it to the UK and other. The US have got a first rate, first world economy. Unfortunately, we've fallen behind and we now have a second rate, second world economy. For me, it looks like I have a very good base case here for the all hail new Keynesian economics trend. Now, I've already mentioned one risk, which would be the continuation of this, which is something for me to look out for. Another is surrounding the globalization. Obviously, there's a lot of issues in the world, particularly in the Middle East at the moment, and you do wonder if there could be a serious crisis involving the US military. So that is a serious risk. But the fiscal discipline of the government, that is a key risk as well to be keeping track of. Here you see how the government is actually spending 30% more roughly than it gets in taxes. It really is incredible, really. Yet the US government selling government bonds to fund running at a very serious deficit. Now, although that does seem incredulous, when I've looked at that over the long term, so I plotted out the fiscal deficits total as a percentage of GDP and also the annual number as a percentage of GDP. And although we see that in terms of the total number, it's up from 100% to 120%, and the actual fiscal deficit yearly is probably quadrupled there to 8%. The proportions here are kind of stabilized. So it looks like they are kind of pushing it to the limit, but probably in this world where everyone's desperate for US dollars, they kind of can get away with it. And then when we look at the yearly budget deficit here, you see that it's not really doesn't appear that bad actually when we compare with the last few years. And again, they probably can get away with what they're doing, as much as we may hate the injustice of that. Interestingly, 23% of the US economy is based on government spending. So we've got to keep track of those risks, and there is a real possibility that you could have a dollar currency crisis caused by all of this indiscipline by the governments, particularly if perhaps foreign countries, like some people are saying, with the BRICS and everything, were to get really turned off the US dollar and stop favoring the US dollar for their currency reserves. So there's a clear risk there. It's something to look out for. And with the all hail new Keynesian economics plan here, with the all hail new Keynesian economics thesis here, we're banking on there not being a currency crisis. My gut feel, though, really is that this will be a trend, which is, why I'm going to bet on it. But I've kind of got like a bit of a pet theory that we'll see AI further develop. We'll end up with some kind of AI bubble reminiscent of the dot-com bubble. And perhaps then in the distant future, as the government gets ever more complacent in winning votes by printing money, eventually it could be like a currency collapse, which sends the whole house of cards collapsing down. But with my gamble here, I'm betting on that not happening for quite a number of years. So I've gone in now because this trend was broken that I've been monitoring for many months. I'm kind of expecting resistance here as we approach the all-time high, and I've gone in half now and half, which will then be a total of 10% of my overall portfolio when we get to the bottom of the channel. And I've got another little pet theory that it will be the US election around here when we'll see it really bust through the all-time high, confirming this lovely channel. So to summarize, and I can be checking against this in future years as I see how my bet has gone. In my opinion, the macro and technicals confirm the all hail New Keynesian economics channel, giving a green light on me to invest S&P 500 tracker. I'm going to invest 10% of my portfolio and I'm expecting a 12% per year return. And I've put there the timings of how I enter that trade. There are risks. If the inflation, or should I say deflation trend continues at its current rate, that could send us into serious deflation, indicating actually a recession, and all of the doom mongers were right after all. The model could be broken by the destruction of globalization, which is what's allowed these deflationary forces to allow NKE to be a thing in the first place. Also, the model could get broken by a US dollar currency crisis, and the effects of fiscal indiscipline could play a big part in that. So the exit will be, if I see is breaking out of that channel, then it obviously was a faulty theory, so I should close the bet. And also, I'll be monitoring these different factors over the years. And if I see something not fitting anymore or looking like it's careering out of control, it might be good then to take your chips off the table. So please remember again, I do these videos just for fun as a hobby. I vlog my investments. It really does help me doing these videos because it forces me to put the work in to then get the best results for me. But my situation is probably very different to yours, so go and speak to your investment advisor. So I hope you found this video useful, and I'll speak to you at the next one. I do videos like this one just for fun as a hobby. It's for entertainment purposes only. You'd be really stupid to make any kind of investment decision based on this video. Always consult a qualified financial advisor before making any investment decision. Prices can go down as well as up.